Hello, everyone, and thanks for joining. We're going to go ahead and begin. Today, we're covering 6 long-term market trends reversing in 2021. We're joined today by our hosts, Charlie Bilello, founder and CEO of Compound Capital Advisors, and YCharts' own Caleb Eplett, Chief Product Officer of YCharts. Should you have any questions for our hosts during this webinar, feel free to submit them on the left-hand side of your screen. We'll also have a short Q&A session at the end of our presentation. Do note that the content of this webinar is meant for educational purposes only, not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. Finally, we'll post a recording of this webinar to the support topics page of YCharts, and we'll send out a copy to all attendees. Now I'll hand it over to Caleb to get us started.
Allison, thank you. And thank you everybody for joining us. And especially thank you to Charlie. I'm excited. This is a big moment for us. We've been working with Charlie for a few years here at YCharts, following him a lot longer. So anybody that's not already following Charlie on Twitter, you're really not getting much out of Twitter if you're not following Charlie. So get on there and give him a follow. Amazing content that you post, on a very routine basis. Aside from that, though, as Allison mentioned, Charlie's also the CEO and founder of Compound Capital. And if I'm not mistaken, kind of juggling a lot of balls there, right? So head of investment strategy, content creation, marketing, doing all of your research, portfolio management, compliance, and handling investor relations too. Is that accurate?
Yeah, do just about everything.
Yeah, so I guess first question is, with all of those responsibilities, how are you able to get so much great content out there on the socials as well?
Oh my gosh, I love markets. I love analyzing, studying markets. I live and breathe it every day. So, if an idea pops into my head, I have all of the charts saved in YCharts and data saved places, and try to make it as efficient as possible and just put it out there and try to generate conversation and try to educate investors. And that's a huge part of what we try to do at Compound.
Well, you do a great job. I have to say, every time I see one of your charts or one of your visuals, you have this innate ability to put a chart or a visual together that addresses a really complex topic, but leaves me 100% clear on the points you're trying to make. You make it very digestible and very easy to understand, which is actually a challenge that I was thinking about as we were going through getting ready for today. Your charts are so straightforward. When we put them up, what are we going to talk about? But we're going to give it a try anyway.
That's fine.
I think this will be fun.
Let the chart do the talking. Exactly.
I like it. That should be our motto, actually.
Yeah.
But we're going to talk about 6 trends today that you've especially noticed having shown signs of reversal lately. And I don't want to spend too much time right now going into each of the trends because I don't want to ruin some of the content that we have to get through here. But I did want to ask you a little bit of question about your points here kind of on the bottom of the slide. So talk about how the COVID pandemic has affected these trends and seeing the momentum as well as the reversal.
Yeah, I mean, it was pretty incredible. Just coming into last year, you had all of these dominant forces that had gone for a decade, if not longer, in many cases. And it was really dominating the investing landscape, right? You had just falling yields, right? You had a flattening yield curve. You had large caps outperforming, and particularly U.S. large caps, U.S. technology stocks really dominating the global landscape, which kind of tied in also with the growth outperforming value. And then also you have the commodities, the deflationary trend of commodities going down and interest rates going down together. So you had all these factors coming into 2020 really dominating things. And then when the pandemic first hit, all of these things just accelerated. Like, as you can imagine, it was the perfect backdrop for many of these things to just continue in that direction, right? We thought we were going to be entering the second Great Depression. What is that going to do to inflation expectations? What's that going to do to yields? Of course, it's going to crush it. And we saw that initially, right? We saw yields hit all-time lows, 10-year and 30-year, just unbelievably low levels. Some people were talking about them, the 10-year actually maybe going negative at some point last year. It seems crazy now, but that was the backdrop. And then, of course, you had large cap companies continuing to outperform small cap companies, because if there's going to be a depression, right, the larger companies should hold up better. They should have better access to financing, or use less leverage in general. And obviously the commodity thing was just an incredible backdrop for a collapse, right? You never had people staying in their homes for a month, 2 months straight, not driving, not traveling, and that set up the perfect storm for crude oil and other commodities to collapse. And then obviously growth. Okay, if there's no growth, you're starved for growth. You're going to reach for growth names and tech names, right? Where tech names really thrived, initially on that pandemic. It seems like Amazon didn't need anything else to help it, and then it had pretty much shutting down all of their competitors, right? So you had companies like Amazon and Zoom, and pretty much anything that enabled us to continue doing what we do just became so much more valuable. You have people stuck in their homes or watching more Netflix. We can take that in a million different directions. So all of these things initially really accelerated, and that made perfect sense to people. And the idea was that that would only continue throughout the year, and that just it was interesting when we saw initially, and it really started with the bond market, and we could start there. We saw things start to shift. This trend slowly start to change, and so that was an interesting thing, because people just weren't prepared for that shift at that point in time.
Yeah, so let's jump in. So this first trend you alluded to, yield curve and the duration reversal. So can you start by just kind of explaining what we're looking at with this chart?
Yeah, sure. This is just a chart of the U.S. 10-year Treasury yields and subtracting the 2-year Treasury yield. So it's what people call the yield curve. You could look at different durations. This is the most common one people like to look at. And as you could see, for years here, we're just flattening. That curve is flattening all the way until 2019, when it inverts. And a lot of people on the call will be familiar with the concept of an inverted yield curve, where short-term rates go above long-term rates. It doesn't happen very often, but it's often an economic indicator. The last 10 recessions in the U.S. were all preceded by this inverted yield curve. So we had this inverted yield curve. We had the Fed cutting rates at that point, and people were questioning why. And the economy still was chugging along. It was the longest expansion in history, coming into last year. The yield curve wasn't predicting a pandemic, but it was predicting an economic slowdown, and ended up getting that right. So, the recession hits, right, last February, March, it starts. And then an interesting thing happens is, instead of the yield curve kind of staying down or inverting again, it starts to move in the other direction. So initially that came on the Fed aggressively cutting rates all the way to zero. So almost immediately they cut rates back down to zero. And then on the longer end here, it starts to slowly just move higher, right? The short end at 2-year yields are stuck, and the longer end starts moving higher. And that's an interesting thing. If you're going to have a depression, you would think that longer term yields would be more anchored, on the downside, but they start moving higher on the expectation of, okay, we're not going to be stuck in this forever. And then, of course, when we have the news of the vaccines and things reopening, that starts to accelerate to the upside.
So as we get into the next chart here, I think this highlights that move you're talking about. We'll get into these terms a little bit over the course of the next 2 slides, and then talk about steepening and flattening. But you mentioned the Fed, and the Fed maintaining these low rates. We've seen the Fed in the past go out and take action kind of further out in the curve, right? If we think back to like 2010, around that time period when they were doing all the open market activity. Do you think something like that'll happen if the curve continues to move in this direction?
Yeah, I mean, they're buying that right now. They're just overwhelmed in terms of the selling pressure, and they really can't. I mean, they can try to control it. We've seen Japan do that, but they'll have to effectively really just take over the entire bond market at that point. And I think they're okay with seeing longer term yields rise if they're rising for the right reasons, which is, growth is coming back, inflation expectations, which the Fed is outright telling us that they want higher inflation, and they're comfortable for the first time with inflation overshooting, right? So This is a consequence of that. So yeah, they could come in at a certain point and try to target longer duration, do something like Operation Twist, like they did the last time, just be more aggressive. But I think for now, they're probably comfortable. They're getting what they want, right? The economy is expected to have, huge growth year. Some people are talking about 6% real GDP this year, which would be the highest since the early 1980s. I think the Fed would be just fine with yields rising in that backdrop. But the interesting thing is on the short end here, right? We're kind of stuck. So this is the first time where we're seeing, right, and we'll get into the inflation charts in a bit, but we're seeing this reflationary behavior, but the Fed's saying, no, we're just going to stay at zero for the next few years. And they're projecting through the end of 2023 to stay at zero, which is an unbelievable statement given what's going on in the inflation market and given what their growth expectation, the Fed's own projection for growth this year is over 6% and then over 4% for next year. So, if that is realized, it would be really unprecedented to see that kind of growth and keeping short-term interest rates at zero.
Yeah, I remember one of my economics professors used to always say, if anyone tells you they can forecast interest rates more than a year out, they're lying to you. I guess it's a lot easier when the Fed just tells us what they're going to be.
That's right. Yeah, we could forecast the short end pretty well, unless something changes there.
Well, let's put it in writing.
Yeah.
All right, so here we're actually looking at the yield curve, right? And I mentioned that we talk about a few of these terms. So, if you could just walk us through a little bit about how these moves in the actual yield curve have historically, impacted markets and how that ties into some of these terms. But I'd also like to hear a little bit of a twist as far as thinking about how the Fed kind of locking down the short end of that curve may or may not maintain some of these trends we've seen in the past.
Yeah, I think with some of this stuff, you just got to throw it all out the window. And I wouldn't go too crazy with the terminology, flattener, bull flattener, bear flattener. It doesn't much matter that, what it's called. But we're seeing, the bear steepener, right? This bottom right-hand corner here where long-term rates are rising, faster than short-term rates, which aren't rising really at all on that expectation that the Fed's going to keep rates at zero for some time. Now, typically, that type of behavior is associated with rising inflation expectations, and at a certain point, historically, it would mean the Fed would have to start to be more aggressive, in raising rates. But the difference here, again, with this environment is they're saying they're not going to do that, right? But for years and years, we're seeing the opposite, right? We're seeing whether it was a bull flattener or the bear flattener, we're just seeing flattening rates. We're seeing long-term rates, falling faster than short-term rates were falling. That was up until the point where the Fed started to aggressively cut rates. When the pandemic first hit, you're seeing that trend, and then we're shifting, of course, since last February into that steepener. So for now, investors are going to watch this as evidence of reflationary behavior. We'll get into the inflation charts, but that's really what's most important. What drives long-term bond yields are two things. One is nominal growth expectations, and two is inflation expectations. So if both of those continue to trend up, you have just that pressure on the long end. In addition, right, we have just a huge amount of supply like we've never had before, right? The national debt's at 28 trillion. It's up 4.5 trillion in the last year. That's a pretty big number. And the Fed is trying to buy a good amount of that, or at least they have tried in the last year. But they're expected to buy, let's say, a little bit over another trillion this year, but there's going to be a few trillion more in supply. So you have all of those forces putting upward pressure on longer-term interest rates.
So as we think about that, and this next chart, this is actually showing a ratio. So I'd love if you can talk about kind of what this ratio means and what this trend means, but explain this too and how this trend is a reaction of that.
Yeah, so this ties into some of the other trends we're talking about, but I love ratio charts. They kind of show relative movement in the markets, and this is just comparing the bank sector, the bank ETF, the KBE, versus the broad S&P 500, right? And as you can see, general downtrend, especially when the yield curve is flattening and going to inverted levels and getting into the recession. Depression certainly wouldn't have been good for banks. If you remember all of the loan loss reserves that they took, it was just unbelievable numbers, right? Expecting to just have huge write-offs. Didn't end up happening, but that was the expectation initially. And banks just, continue to underperform. And then we saw this reversal kind of, coincide with that steepening of the yield curve. And the idea is that banks are going to benefit from that. Banks, they're going to be able to lend at higher rates, borrow still at short-term low rates, and that spread will be good for bank earnings and bank stocks. In addition, right, the economy is recovering. That's good for banks. We're going to have increased lending activity. So all of the above has kind of led to that reversal in bank stocks starting to outperform.
So if a rise or a steepening yield curve is good for banks, who suffers in that environment?
Anyone who gets hurt by higher interest rates, right, at a certain point, right? I guess that would be. I don't know if they're necessarily hurt by it, because most sectors, even if they're kind of immune to higher interest rates, are cyclical somewhat. So I would say more defensive plays, maybe like a utility sector, which is more tied to interest rates. So you got interest rates rising, utilities tend to underperform, and they have been in that type of environment. So those types of stocks would be, yield plays, things like that, where they're just getting hit because there's more competition. But on an absolute basis, that might not be true, right? But on a relative basis, you'll see the difference there.
That makes sense. And I guess as we think about just outright rates, right? Still historically pretty low, based on the chart. So how do you think about the outright rate in relation to the overall yield curve move?
Yeah, like you have to keep this all in perspective, right? The yield curve is different than just the absolute level. 30-year yields are still ridiculously low, right? At 2.4%. That's as you show here in the chart, 4.9% is the average since 1990. Still very, very, very low. We're just getting back to pre kind of COVID levels here. So certainly not extreme, still very low. Certainly not going to put pressure yet, let's say, on borrowing or lending. And we don't have charts in here showing corporate bond rates, and yields, but they're still pretty close to all-time lows. So it's certainly not a hindrance just yet. And it just shows you how far down that 30-year came, but below 1%. People were willing to park their money in a bond for 30 years at below 1%, which is pretty unbelievable, right? I guess not so much to people in Europe, where we've seen negative 30-year yields, but here in the U.S., where we're used to having positive interest rates on our and getting a return on our money, that was kind of eye-opening when it crossed below 1% on the 30-year.
Yeah, certainly. So money's cheap, and I guess maybe one of the most relatable impacts of interest rates that consumers see, or anybody who might be in the real estate market is mortgage rates. So what are you seeing here, and what are you thinking about mortgage rates?
Yeah. So mortgage rates really followed the trend lower in yields, and then they continued to do so even after yields bottomed last year. The spreads in mortgages were going down, and whether that's the Fed buying, tens of billions of mortgages every month and pushing that down, but the spread really just kept compressing until 30-year mortgage rates hit an all-time low to 2.65% in January this year. Just incredible. So, and probably plenty of people on this call here either refinanced, or if they were lucky enough to lock it in below that levels, will be telling their kids or grandkids about how they got that rate, such a low rate, right? And anyone who's older on this call will remember mortgage rates being 15% and above in the early 1980s. So it's such an extreme 40-year move lower from where we peaked in the early 1980s to early this year at 2.6%. So, but the point is, in the last 2 months, that increase in the long end of the Treasury curve is starting to put pressure on other rates, and so we're seeing that mortgage rates start to move wider, which is to be expected. Still very, very low, right? We're just back to last June levels, let's say, on the 30-year, but certainly different, right? If this were to continue, let's say this would go to 4%, perhaps that would start to have somewhat of an impact. But for now, the housing market is absolutely on fire. There's very little supply. There's a ton of demand. So prices are up, I think, 11% U.S. nationally over the past year, which is the highest since 2006. So it's just they've created a real housing boom from the combination of the stimulus payments, ultra low mortgage rates, and the Fed's obviously involvement as well. So, I don't think that this is going to bring down the housing market, this little move higher just yet.
Yeah, I agree with you. But, thinking about expectations too, it's interesting. This next chart actually looks at what people are expecting interest rates to do or expecting inflation to do. Can you explain, first of all, kind of what is on this chart, and then also kind of how these expectations may influence, your own tendency as far as where you're investing?
Yeah, absolutely. So the inflation, a lot of people hear about, there's many different ways to measure it, but everyone knows about the CPI, right? That's reported monthly, and that's kind of the standard measure of inflation, which is trying to take a basket of goods and measuring their changes in price over time. This is a different way of doing it. This is a market-based implied inflation, and really it's just taking the nominal yield on that. Let's say here we're looking at 5 years. So we're looking at 5-year treasury yields, the nominal yield, and subtracting the yield on TIPS, treasury inflation protected securities, the yield on that, and that gives you what's known as the break-even inflation rate. So, here recently you can see just that unrelenting surge higher in this expectation, and the spread between nominal yields and TIPS yields just widening and widening and widening on the belief that inflation is going to pick up, right, in the future. And this really is a huge driver of what we're seeing in bond yields being pushed higher. Is if you're going to have higher inflation, you want to be compensated for that in terms of the yield you're getting on your treasury, so you're going to demand a higher yield. So that's the backdrop behind that. The big question is, okay, is the market ahead of itself, or is this going to be accurate? A lot of people are skeptical whether this is just a short-term move or not. But I think what's really interesting is that it's gone up so much, and there's no change in Fed policy, right? They're actually welcoming that. So that's a huge change. And I think that, to predict, I think there's a definition of inflation that I think kind of fits in this environment. And it's the saying is when there's too much money chasing too few goods, you get this demand pull inflation. And that's certainly fits what we're seeing here. We have so much money in the system chasing just a limited amount of goods, whether that's housing, looking at lumber pricing, whether it's used cars. But we could see it in so many different areas of the economy where this pent-up demand is going to be spent. So I think for a little while it makes sense rationally for this to actually actually follow through, and we're going to see the effect of that. The CPI is lagging, so we're going to see in the next few months, we should see that CPI move up north of 2%, perhaps even hit 3% at some point this summer. It wouldn't surprise me.
So do you think this warrants an allocation to TIPS in a portfolio, or is that something you're considering?
So TIPS are a weird animal. They have a duration component, so it's not straightforward. You have to be betting. So let's say you're looking at 5-year TIPS right now. You have to be betting that inflation is going to be higher than this number for you to benefit, right? Because the real yields on TIPS right now are negative. So it's a very weird dynamic, So if actual inflation isn't above this 2.5%, you're going to be better off buying that nominal treasury bond now. If you think it's going to be higher than that, you buy TIPS. You think it's going to be lower than that, you buy treasury. So it's all about what your outlook is, for inflation. If you think we're going to see 3, 4, 5% inflation, then sure, you'll do fine in TIPS. If it's going to be if this is short-lived, you might be better off buying treasuries. But certainly it's one way to protect you against that tail risk of higher inflation. But as we'll talk about, commodities and even stocks and other things are historically have been better protecting you against inflation than TIPS.
And you mentioned the duration component, right? And that's kind of where our next slide takes us, is talking about the performance of different durations. So again, if you can talk us through this chart and what this trend was showing for a long time, and kind of what the reversals indicate.
Yeah, so this is similar to the yield curve, but just looking at the strength of a short duration treasury bond, so less than 1 year, versus the longest duration treasury bond ETF, which is 20 plus years, the TLT. And as you can see, for years and years and years, you got paid to take that duration risk. As interest rates were falling, the higher the duration, the more sensitive you are to interest rate changes. So when interest rates are going down, something with a duration of 20 plus years, if interest rates go down 1%, you're going to make 20% return on capital gain on that bond. So just this was the best environment right here for that long duration play. Since kind of last summer, we're seeing the opposite, right? Duration has really been a hindrance in your portfolio because yields are moving in the opposite direction. And not only that, you're starting at the lowest yields that we've ever had, right? So you're starting at a 30-year bond at less than 1%. So there's no cushion, right? So you're getting all the downside of interest rates going up, but you don't have that coupon, that high coupon that's kind of balancing that decline. So it was an interesting, and this is a little bit wonky, but it gets into bond math. The lower the yield on a bond, the duration increases. So the duration of these instruments, like a TLT, increases as yields go lower and lower and lower. So here last August, you're at the point where it's really almost all risk with very, very little reward.
And we kind of added a couple visuals here to this chart, looking at fund flows, and just a little context for everybody, right? The first chart I had on here when we first talked through this was the comparison in flows between SHY and TLT, SHY being the 1 to 3 year duration treasury ETF. And then Charlie, you pointed out, you said, hey, this chart's really looking at SHV. So I looked at those flows too. Interesting, right? Because you see these outflows out of TLT, which makes a lot of sense based on what you said. And we're seeing inflows into SHY, but outflows out of SHV. So we're seeing really it seems like investors kind of moving towards lower durations, but not wanting to be too short on that yield curve. Do you think that's because of that phenomena you just talked about?
Yeah, it could be, or they don't want to have. They know that SHV is going to give them 0 for a few years.
They want a little bit.
Maybe, the 20 basis points that they get in a 1 to 3 year bond is better than 0. So, and after fees, the fees aren't high on these ETFs. These are index ETFs, but after fees, you could actually have a negative return on some of these shorter duration, treasury ETFs. Something we've seen with European bond ETFs for a while now. It's kind of a wild concept where the expense ratio on the ETF is higher than the yield on the underlying bonds. So it could be part of that as well. But yeah.
Right. So I mean, you mentioned those negative returns if possible, right? And your next visual, we're looking at a chart of bond returns. I'm seeing some red. So talk me through this and how you think about these different types of bonds and their, I guess, decline year.
Sure. Yeah. So this is a table I put together from YCharts, under the funds screener, and I download all the data into Excel, and you can pull it in there directly. So it's a combination of that. But it gives me a good snapshot of all the different types of bonds and different durations. And how they're doing, on different time frames, right? And so here are just a few key points. We have the duration of the bonds, we have the yields of the bonds, and then the returns over here. So as you can see, this year, this is sorted according to 2021 returns. You can see, as we get longer in the duration, and the longest duration bond here is the Zeros ETF, which is over 27 years of duration, has done the worst, right? And then you see all the shorter duration bonds have kind of held up. And also you have credit sensitive bonds like high yields. They tend to have lower durations, and they have higher yields, so they're less impacted by a rate rise. They're more kind of a hybrid between a bond and a stock, right? And so as the stock market's doing well and people are expecting good things in the economy, credit spreads are tightening, and so high yield bonds are actually holding up pretty well this year. They're close to flat. So this is just taking a look at the duration in your portfolio. If you own the average, like the aggregate bond, which is what a lot of investors own, you're down about 3% this year. Not a huge down year, given we've had a number of strong years in a row here, 2019, 2020. But interestingly, this would be the worst bond year for bonds in history if it ended today, which previously 1994, and some people might remember the interest rate rise that year, but this could be the worst year for bonds in history, and it's so far it's all due to duration.
And the next chart, highlights this fact even more, right? That the ag is actually down a decent amount year to date. I know, when I think about my own investments, you never want to look at your bond portfolio as something that's, subtracting value from your overall investment strategy. It's supposed to be there to keep you safe. So how do you talk through this, and how do you think about this when you're talking about allocating?
Yeah, it kills people, right? This is supposed to be the money that helps you sleep at night, and they associate bonds with just having stable principal, and they are relatively stable if we compare them to stocks, but people just aren't expecting to lose a few percent from their risk-free bonds. So as we're learning, bonds aren't risk-free in terms of the principal risk. When interest rates rise in the short term, bond prices are going to come down. As interest rates keep rising, interestingly, the more bond investors will benefit from that longer term, right? So if you're a longer term bond investor, you want to see interest rates rise because that's the only way you're going to earn a decent return. But none of this, I don't think, changes. We can debate about which bonds to have in your portfolio, and certainly there was a case to have shorter duration bonds given where yields were last year. I think that made a lot of sense. But I think overall investors still should view bonds as that part of their portfolio, that's not correlated with stocks, and that helps you stick with that stock market exposure during periods of stress. And it did that last year during the worst periods. If you had exposure to bonds, it helped you rebalance into stocks at more attractive levels. Last March and April, right? So, I think that's the way most people look at bonds, and that hasn't changed. It's just the reward side is just not there, right? As long as interest rates remain so low, you still have that capital preservation, but it's just more difficult until yields rise.
Yeah, it's funny how short people's memories are, right? When you think back to, I think the difference between a 60-40 portfolio and an all stock portfolio at the peak of the crisis last year was, being down 15 or 12 to 15% versus 30 to 40%. So that protection is important to remember.
Absolutely. Yeah.
All right, so let's jump into trend number 2 here, size reversal. So what are we looking at on this chart?
Yeah, so here's the ratio: small caps, the IWM versus large caps, and similar to yield curve, right? Similar to all these trends we're talking about. You have a longer term downtrend, really accelerated when COVID first hit, right? Expectations, small companies are going to get hit the worst. There are going to be a lot of bankruptcies. They're going to be the ones that go bankrupt. What do we have? Just a handful of names you can remember: Hertz, JCPenney last year, right? But there's not a ton of names, right? Given what was supposed to be a very low default rate, very low impact there. And then just an interesting thing happened last November. We get the vaccine news one after another. We get Pfizer, Moderna, AstraZeneca, 3 weeks in a row in November, and just small caps just rocket on that news. And then also on the expectation of the second stimulus bill, and then the third stimulus bill, the narrative changed to small caps being hurt the worst by this environment, to perhaps small caps being helped the most. And this is a pretty violent reversal. It's very quick, just pretty much on a dime. There wasn't much time to get in. You had to just chase it if you weren't in already, right? It was pretty unrelenting, that move higher. and just shifting that decade-long kind of outperformance of large caps.
And if we look at the next chart here, we can see more history, right? It's the same ratio, if I'm not mistaken, but here we've got a more amount of time period. It makes this move seem like a little bit more of a reversion to a mean, but is there something else here?
Absolutely. But this is just to point out, and I was talking to people about it last year, and people, after a 10-year period of underperformance, it's very tempting to say that asset class is dead, it's never coming back, all these things, and just you didn't have to go back too far for there to be a multi-year, over a decade period of small cap outperformance, right? So there's cycles to everything, right? Small caps, are said to outperform over really long periods of time because you're taking more risk, and there's more growth there. There's various reasons, but that's not constant, right? There's cycles to that, and we saw a 10-year period following 2000. 11-year period where small caps actually outperform. Are we at the start of that? We'll see. This start has certainly been much more violent. As you said, we're kind of back to maybe the mean here. But that's just to point out that these things run in cycles, and when it's most painful to have something in your portfolio, that's when you have to start thinking about maybe having some exposure there if it's not there already.
And thinking about that risk on, right? Like how small can you go? Here you got the micro caps.
Yeah, I mean, this is a phenomenon. I mean, this is a multi-standard deviation move. If we were to measure it, it would be off any type of scale that would be predictable based on what's happened in the past, because we really haven't seen this type of move ever. And it's just how much risk can I take? Again, it started after the vaccines with the stimulus payments. Some people say people got their stimulus and they wanted to buy penny stocks and micro cap stocks because there wasn't enough risk in larger cap stocks or even small cap stocks, and this is what the result of that, right? So, we've seen it with GameStop, we've seen it with crypto, we've seen it with SPACs and IPOs. There's just an enormous amount of risk appetite in the market right now, and this is just a reflection of that and how violent that move was.
So if investors have been interested in risk and interested in small caps and interested in GameStop, something they haven't been interested in, right? Being invested in commodities. Maybe a less compelling reversal on this chart, but what are we looking at?
Yeah, so this is commodities, one of the bigger commodities ETFs, the DVC versus the S&P, and for years, just huge secular downtrends. No one wanted to invest in commodities. Crude oil is the biggest component, and other energy like heating oil and gasoline are also big components here. So that's really driving a big part of that. But other commodities look pretty similar to this as well. And so just a huge secular downturn in commodities, right? The opposite is tech, and we'll talk about that later. Tech moving in the other direction. So why do I want these old commodities doing nothing for me? I want technology, I want scale, I want things that have growth, right? And so this downtrend also coincides with that kind of deflationary environment where you have yields falling, lower growth, you have demographics, impacting this, so population growth slowing, less demand for commodities. You have innovations in technology, making it more efficient to refine crude oil. A lot of factors, right? No reason to own commodities. Certainly after the pandemic started, and we'll show in the next chart what happened to crude oil. But so in April 2020, this is something nobody had on their list of things of what would happen. And the price of crude oil, at least the futures market, actually turned negative last year, for a brief moment. It didn't last very long, but it was just emblematic of the collapse in demand. There's, so much supply out there. Crude oil turns negative, and that is the perfect environment, that capitulation, to say, okay, maybe we've overshot to the downside. Maybe we're not going to be shut down forever. Maybe things hopefully will come back, and that'll drive commodities. And wouldn't you know it was. And now we're seeing some upward pressure in crude oil and other commodities. And again, that's coinciding, right, with the reflation kind of trend, the higher interest rates. All of these things are tied together. I think in a broad portfolio, people are underweight commodities. Certainly has been the right move for 10 plus years. But the question for investors here is this going to be a multi-year type of move where we see commodities outperforming, or at least holding their own versus stocks? They don't even have to outperform, but just holding their own and not going down like we saw from, let's say, 2002 to 2007, 2008, where we just had a multi-year period where commodities and commodity stocks actually outperformed. I think I think we have a chart of that.
And do you think the primary driver in the recovery here is demand then? Is it, we think about, any type of reduction in supply, increase in demand, or even a movement in the dollar or something like that could have a big move on oil prices? Is this demand driven?
Yeah, I think it's just coming right now. We're just getting back to pre-COVID levels on the expectation, right, that demand is coming back. The ISM came out today, this morning, highest level since 1983. So there's a lot of activity that's going to be coming in the pipeline, whether it's new, right? We talked about there's too few goods. There's going to be, for a period here, there's going to be a little bit of a manufacturing boom. There's going to be people traveling again. So the last time I looked a few days ago, U.S. air travel is now down 40% versus 2019 levels. That's still a lot, but that gap is going. That's the least we've been down since the pandemic began. And in the past few weeks, it's starting to really pick up. And I think by the end of the summer, there's an expectation that, as we hit herd immunity, hopefully we're going to see just more demand for travel and resurgence. And so, no, predicting crude oil is like predicting interest rates. It's a fool's game to do it, but I think perhaps that multi-year trend of just commodities being outright terrible, maybe that's reverse course. And so this is kind of reflecting energy is the most correlated with broad commodities given crude oil's impact. And so we saw just a huge decline in energy over the past 10 plus years. Oil prices peaked at over $150 a barrel back in 2008. They bounced around for a long time, but really the last 10 years have been just terrible for energy investments. The anticipation last year, we're just going to see a wave of bankruptcies and restructuring, obviously with crude oil going negative, or all of this negative stuff. It was the perfect sentiment environment to say, maybe we're going to have a reversal here. And it's not huge looking at the chart so far, but this ties in with the theme of perhaps there was some value in this. This is the anti-tech trade. This is something that is less correlated to that broad market tech trade. And if you think this is going to be a multi-year commodity resurgence, if you think crude oil is going to go to $100 a barrel again at some point, which I don't hear anyone saying, but certainly a possibility, then energy for sure will benefit from that.
Yeah, and you mentioned this being perhaps a better place to, add an inflation hedge than tips too, right? So.
Yeah, you're going to have certainly much more volatility, but yeah, if there's a real reflation, if there's a 1970s type of crude oil spike and just a real multi-year inflationary period, energy stocks are going to be better for you than tips. A lot more volatility.
All right, so the next trend we're looking at is geography. Talk us through this one.
Yeah, so here we have just looking at global stocks versus U.S. stocks. So there's just everything outside the U.S. So MSCI World ex-U.S. So it includes developed markets, emerging markets, everything just not U.S. stocks. And this has kind of been the chart that anybody who's diversified really has been painful. If you're a U.S. investor and you've been diversified globally, you have a basket of international or emerging market stocks, for over 10 years, that's been a bad move, so to speak, right? Just in terms of performance, right? Because it's just an unrelenting downtrend. This is really, what's behind this is the growth of U.S. technology and really the dominance of that, versus the rest of the world. So the growth rate of Apple, Amazon, Google, Microsoft has really driven a big part of this. And so it was interesting last year, so given what went on, that to see this kind of reverse a little bit. And again, not huge, similar to energy, but we started to see for some time global stocks start to outperform U.S. stocks. And the question is this going to be going to continue? And is there any precedent historically? And for new investors, they might think, wow, there's no reason to diversify out of the U.S. But I would point them to something like this. You don't have to, again, go back very far. It's similar to the small cap versus large cap situation that we saw from the early 2000s. So going back after the tech crash, you start to see leadership change where international stocks outperforming U.S. stocks, emerging market stocks even more so outperforming. They did so, for quite some time. And so this is just the point is that if we're looking out decades, it's helpful to have some international exposure because we can't predict the future. We don't know what is going to be a leader in the future. And the U.S. has gone 10 years without any return. If we look at 2000 and 2010, S&P 500 was actually down over that period when international stocks are up a good amount, emerging market stocks more than doubled in that period. So we have precedent for that. And if there's going to be a shift in terms of growth and technology, this would be something, that perhaps could protect you a little bit against that.
Yeah. Well, one thing I really like about this chart is it highlights what I think of as this kind of 10-year investment performance metric bias, right? So many people are used to seeing a 10-year chart of how well a portfolio is performed or drawdowns over time or performance of an index or a benchmark. Because of that period of time spanning more than 10 years, we get a lot of demand at YCharts where people say, hey, we want to go back 15, 20 years. And this really highlights the value of doing that, kind of going back beyond the last 10-year effect.
Yeah, just think longer term, right? And today it's hard to do that. People are looking at 10 minutes, and to look at 10 years, that's an eternity. And yeah. So speaking of an eternity,
so our next
yeah. I mean, if you're a value investor, it's been an eternity for you to have a reason to own value stocks. Value versus growth. This is a ratio. This is a big value ETF, Russell 1000 versus growth. And this is just the last 10 years. But if you pulled it back to 2006, that's actually when that ratio peaked. So we're looking at 14 years of underperformance for value stocks. Just an unbelievable long time. Probably the longest that we've ever seen if we go back the last 100 years. And that ratio, interestingly, right, it bottoms last September. And we start to see a shift here where value's finally starting to outperform. And some of that is financials. We looked at the banks, right? They're a higher component in there. Some of that is the energy sector. Just anything with lower growth expectations, lower multiples have finally started to show a little bit of life, right? And I don't think many people are expecting this to continue for very long, but it's something definitely to watch. It's been a huge factor driving markets for the past 10 years, and so if we're going to see a reversal, I think it would have a huge impact on portfolios.
Yeah, and upon seeing this chart and reading through your original blog post, what came to my mind was like, let's look under the covers, right? Let's see what's actually moving both of these funds. So looking at IWD and IWF, what jumps out at you when you look at the big movers in both of these holdings?
Yeah, so you just left side here, we're looking at value. You got banks, right? You got energy. You got tech stocks like Cisco that nobody cares about anymore. They were once growth names, but then they became value names. So just more unloved names that you typically don't see in a portfolio. And on this side, just the more standard tech names, right? You got Tesla, which is considered a tech name, even though they're a car manufacturer. PayPal, Netflix, Microsoft, Amazon, right? So it's just that shift, right? And you can see it in the returns here, the last month and year to date in particular, where values, starting to go up and growth down. But if we look at the 1 year period, right, there's still growth is still holding up quite well. So you just had this huge move higher in growth right after the pandemic, and now just kind of a relative going sideways for the last 7-8 months, while value, opposite, right? You just a huge relative crash, and now just a huge mean reversion shift.
And you alluded to this as you were talking through the original chart, right? But looking between these two funds too, you can see some significant differences in a few different sector exposures.
Yeah, definitely, right? Tech being the most glaring here in the growth side, 38% and versus 10% in value, and also we have if you look financial services, look at financials, 20% in value, 7% growth. So just that's driving a big part of that, right? Just the sectors that have been beaten down and unloved for so long are going to have more value than sectors that have done well, like consumer discretionary, cyclicals, and technology.
And are these sector differences typical? Would you expect to see these allocation differences between value and growth, or does this shift over time?
It definitely shifts. Yeah, there are times, coming out of before tech began its recent run, there was, Apple was in the value side, right? People probably forget that, but I think as recently as maybe 2014, you look back and Apple's, was considered a value stock by many, right? So this, last really 5-6 years have shifted tech more than we've seen since the late 90s into 2000. Have shifted the weights of tech to really overweight in that growth area. So it definitely shifts over time, and it's definitely cyclical.
And as you talk about the cyclical nature and kind of that shift, right? So these tables are really interesting, right? So you've got the kind of biggest winners from 2020 and kind of what's happened to them in 2021, right? So can you talk us through this a little bit?
Yeah, so I put this together as just an idea in my head. Let's take a look at last year. Using the YCharts screener, right? Just pulling up the S&P, looking at last year's return and year-to-date returns, and let's sort them top 25 and bottom 25 and see how they're doing this year. So the left side here is just top 25 stocks last year in the S&P, led of course by Tesla. And how they're doing year to date. They're down a median return of 3% as of the end of last week. And if we look at the worst performers last year, got your cruise lines and airlines and energy names, right? Every single one of them is positive. These are the worst 25 stocks last year, up a median return of 32% this year. So this just highlights the reversal we've seen in value versus growth certainly is part of this, and part of it's just mean reversion in general. These things were so beaten down and so extended that they're snapping back, and on the other side they were so extended, right, and they're snapping back in the other direction.
Yeah, and when you look at the the industries listed here, it becomes apparent like how much technology and maybe healthcare you see on the left, and on the right there, so much oil and gas and some of these travel stocks, which leads into kind of this next chart where we see the actual performance of the sectors and how that itself also kind of rebounded year over year, right? Yeah,
for sure, right? So just energy, financials leading this year, tech and discretionary underperforming. That's the exact opposite of what we saw in 2020. If you look at the table here, just best has become worst and worst has become best, and so pretty much on point.
Yeah, and that leads us into our last trend here, which is the sector reversal, right? So another great ratio here. If you can talk us through this one.
Yeah, this is broad market versus the tech sector ETF, and this is probably the most dominant trend in markets that we've seen. It was the last one to flip out of the 6 last year. Probably going to be the one that's most difficult for people to conceptualize, just because if you look at the companies within that tech sector, it's hard to envision a scenario where they're not dominating in the future. It's very hard to think it when something is doing so incredibly well as these big tech is doing. It's hard to envision a time where they won't be leading. And so they won't go down without a fight. I don't think this is by any means a foregone conclusion. Certainly,
you're not buying into peak tech.
Well, it very well could. It's just there's gonna be reluctance, right? And if there's any hint of some of these other trends not playing out, people will go back to where the growth is. But I think just a broader point is think about that tech exposure in your portfolio. If you have a huge overweight, that's benefited you enormously, and thinking about rebalancing some of that, whether it's just into a broad ETF or hedging it with some value exposure or international exposure, something in case you're wrong about that tech bet. There's no question technologies in every single sector, right? There's no question tech and software are the future of every industry. Just the question is, what are investors today paying too much for that? Are they over optimistic about the future to the point where tech can do incredibly well, but still perhaps underperform, right? So Cisco is probably the best example, or even Amazon following 2000, right? They executed very well, these companies, many of them after the dot-com bubble, but they still got taken down because multiples were just so high. The expectations were so high, they could not grow into them, right? And I think we're going to see some examples of that. We're already seeing some examples of that, but we're going to see some examples where the expectations of investors following last year, where you're really pulling forward 10 years worth of growth into 1 year, investors are expecting that the growth in some cases to continue at that pace. Well, reality is going to hit at a certain point this year that last year was a little bit different. So I think it's more about, rather than predicting a top in tech, it's about predicting, having something else in your portfolio just in case tech isn't doing as well. But tech, it's in everything. If you're in a broad U.S. index fund, tech is going to dominate that. So you have to think about that as well, right? So you have that exposure. If you have that plus individual tech stocks, plus a lack of internet, well, now you're really concentrated in that one single bet, and that's what I would be careful with.
Yeah, that makes a lot of sense, knowing what you actually own. And I think we've got one more chart here, and I guess this is just kind of going back and looking at, hey, can the market outperform tech? And again, let's open up our history a little bit to see what happened.
Yeah, so this is, of course, following the most extreme period in history, right, for the markets, where, at the end of the dot-com bubble at the peak, tech, the market's just underperforming tech, and then just a complete reversal, right? There was a 3-year bear market. NASDAQ was down over 80% during that period. You had many tech companies go out of business. And just the point here is that it doesn't have to be this sharp. This is a unique scenario. Point is, but there can be periods, and there will be periods where tech, multi-year periods where tech underperforms. Is it here? I don't know. No one knows. But if we pulled this chart back even longer, the ratio is getting extended. So if we flip this and put tech versus the market, you're not that far from 2000 levels. You're not as crazy as that, but we're not that far from those levels. So now would be the time to start thinking about it.
All right. Well, this has been great. I really appreciate it. Charlie, I was hoping that as Allison collects a few questions here, or organizes some of the questions she's collected. I know we're at the top of the hour, so some people might end up dropping off, but I think we could field a couple questions anyway, if that's okay with you.
Yeah, let's do it.
Perfect. And then as she gets those together, if you could just maybe spend a minute or two talking through some of the tools that you use to put together some of your great visuals and analyses.
Yeah, sure. So there's YCharts really is critical to me to putting out the visuals that I do. And so I have every visual that I put out, I have a process, and I have different ways of looking at it. So some of the tools that I really rely on with YCharts, definitely obviously the fundamental charts, and as we've seen here, and doing ratio charts there. But more than that, just digging in deeper, doing analysis. I love doing stuff in Excel. So pulling data from the time series charts or the screener, and using the watch list with both of those as well. For playing around with different portfolios and pulling up visuals of that are huge as well. So there's probably not much in YCharts that I'm not using. I love the Excel stuff. I'm a big fan of trying to automate stuff. So pulling, to the extent that I can, pulling in data into a chart and just trying to, as we talked about earlier, try to take complicated information, because a lot of this stuff, it may seem simple to us, but to most people, it's like a foreign language. So trying to distill something down into a simple chart is valuable for people that I found. And they'd rather look at a chart. I like to write, and I write a lot on the blog, but I've learned that they'd rather see a chart from me than read a whole piece about it, right? If I could distill that down as quick as possible. That's what I started doing last year. Started doing this 5-chart Friday thing, where I'm just taking the week and thinking about 5 different charts or tables from the past week that really tell the story for the market. And education is number one for everyone here, because as much as we analyze the markets and study them, being humble and having a context of history really is important for investors. Nobody knows the trends that we talked about today. No one knows exactly where they're going to go. It's just being cognizant of them and what that means for your portfolio, and understanding the different scenarios that can happen. That's the value part, not so much as predicting exactly what's going to happen from here, which nobody can do. So just being prepared for different scenarios and trying to look at history and using visuals to illustrate that.
Yeah, and to kind of bring things back to where we started, you do such a good job of that, and you're a true power user when it comes to YCharts. So I hope we can tap into more of your insights as we go. But I think Allison does have a couple of questions that we were going to try to squeeze in here. So John, Allison, why don't you jump in and
Yeah, that's right. Thank you, Caleb. And I know we're running a little over time, but that's right. I do have a few questions for you. I think this first one is pretty much for you, Charlie, but what are your takes on dividend payments versus bond payments as a source of income over the next 10 years?
Yeah, this is one I get a lot of, especially in a yield-starved environment. A lot of people think about substituting higher dividend paying stocks for some of that bond portfolio, especially when the yields on those stocks out are higher than the bonds. I would just caution people to look at the risks of the two. They're not even close to one and the same. So, and actually looking at dividend stocks as a basket, if we look at an ETF like a DVY that has higher dividends, if you look at the historical drawdowns in the last few bear markets and recessions, you'll see that they're actually higher than the broad market. So the safety that people assume comes with that dividend isn't always there, and there's a reason for that. There's a lot of those companies that are paying higher dividends. Some of them are more stable, but a lot of them are paying them because they're having more trouble with growth, and they'll get hit harder in a drawdown. So you just have to go back to like 2007 to 2009 to see these high dividend paying stocks, and people were reaching for yield, same as they're doing now. And many of those ETFs were down 60+%. And last year, they'd be down 40% or more, right, in that short period of time. So just 10 years, if you have that 10-year horizon, I'd be willing to bet dividends will do better than high dividend paying stocks will do better than bonds. You just have to be able to stomach that, that volatility in between.
Yeah, great. Thank you. So I think we'll just end with one more question for today. Of the various chart relationships, the 6 that you've highlighted, what do you think have staying power and which may be more temporary and could reverse?
You want to take that, Caleb?
I think that one's for you, Charlie. Nobody's hearing my thoughts. I'm excited to hear what you say too.
Yeah, I think the yield curve thing will be difficult to reverse for a little for at least this year, just given the trends in inflation that I think are going to be sticky for at least another year, and then we'll see what happens if there's going to be more stimulus or what happens with the infrastructure that that could sustain it. But I think that one of all of them, I think that would be difficult for that to reverse too much. Certainly on the short end, the Fed seems pretty adamant they're not going to move. So, that spread should at least maintain. Will it increase from here? I think that'll depend on if inflation actually follows through with the expectations. And in terms of the other ones, a lot of them are tied together. If we do see that reflationary environment, then the commodities trends that we're talking about should continue. The yield curve things related to financials and banks. So if that maintains, you could see continued strength there. The big one that I'm asking myself, because everyone's is on the tech side, and just how much faith do you have in tech in general, and then do you have to be more selective maybe in terms of what within that tech of what's a more sustainable growth trend and what's priced into some of these names going forward. So that's something I look at. But certainly things like small caps, much tougher to say because of how quickly they've moved already. And micro caps, right, even more extreme than that. It's hard to say. But I think the yield thing is a more sustainable trend, and it has some legs if that inflation comes through. We're still at 170 and change on the 10-year. That's still pretty low if we're going to have a reflationary environment.
All right. Thank you so much, Charlie, and thanks, Caleb, of course. And a big thanks to everyone who joined us today. We'll be sure to send out a copy of this webinar to all attendees in case you want to review anything we talked about today or to share with your colleagues. If you liked any of the visuals that we went through today and would like to create them for yourself, sign up for a free trial on YCharts.com. Thanks again, everyone.